In today's video, we're going to be talking about my 5 pension hacks that will change your retirement for the better. Stick around because one of these tips does change from April 2025. Hi guys, welcome to the channel. If you're new here, I'm Brett. I've been where so many people are, drowning in debt, feeling stuck and unsure how to get out. I've gone from owing tens of thousands to becoming completely debt-free and building my own personal wealth. All by learning, applying real strategies and making smart financial choices. Now, I want to share what I've done and all the lessons I've learned in a way that's simple, relatable and practical so that you can take control of your own finances just like I did. If I can do it, then so can you. Tip number 1, auto enrolment. For the last decade, employers have been required to contribute to your pensions. What this means is, if you put in 5%, they are required to put in 3%. There are some age restrictions to this, so you must be over the age of 22. If you are between 16 and 21, it's still okay, you can opt in, but you must request that manually through your employers. This is effectively free money. They're just giving you 3% extra on top, which means the sooner you can get that into your retirement savings and the more time it has to grow, the better it's going to be. There is also something called qualified earnings, which means you must earn between 6,240 and 50,270 in order to hit that auto enrolment scheme. So if you're in that bracket of both the age range and the price range, you will automatically be enrolled by your employer. And what this means is they're effectively just giving you a 3% pay rise every single year. So take advantage of it, the sooner the better. In this example, we're going to take a look at Jack. Jack has a salary of £31,240. We first must remove the qualified earnings, which takes us down to £25,000, and then Jack will contribute 4% a year, which means £1,000 a year going in. The government will then give him 1% tax relief going on top, which means that's another £250. And Jack's employer is required to put in 3%. That's another £750 put in. In total, Jack's saving £2,000 a year automatically into his pension. But here's the kicker. This isn't costing Jack £2,000 a year. It's actually only costing him around about £800 a year out of his pocket. After all the taxes and all the deductions, that's all he will lose from his salary. Now check with your company. Many companies will contribute more than the 3%, which means you're effectively leaving free money in their pockets. I myself am lucky and fortunate to have an employer that will contribute 10% when I contribute 5%. But that does scale. So if I contribute 4%, they'll only contribute 8%. If I contribute 3%, they'll only contribute 6%. So check with your employer. Make sure that you're maximizing that because it's the closest to free money you'll ever get. And your future self will only thank you for it. Tip number 2, log on to your pensions. According to an ONS 2021 report, 79% of us now have a workplace pension. However, a Financial Conduct Authority survey shows that only 47% of respondents had even reviewed their pensions in the last year. This means that almost half of everyone that's got a pension have even bothered to look at their pension in the last year. There are many reasons to log on to your pension. Firstly, review the default fund you are in. Pension providers pick a certain bucket that invests all of your money in every single month. This is often aimed at appealing to the masses and may not be exactly what you're looking for. Decide if the funds you're in are meeting your goals and your risk tolerance. For example, 100% stocks and shares exposure, often called equities exposure, may be too risky if you're about to retire. But in the long run, 10, 20, 30 years into the future, we've seen great returns in the past from this sort of exposure. Reviewing and making these decisions yourself allows you to take control of your own future, meaning that you can be in control of what your retirement looks like. Secondly, adding beneficiaries to the pension. A survey in 2023 by the Money and Pensions Service of 2,561 UK adults with a pension found that just 41% correctly said that it would go to their nominated beneficiary in the event of their death. This means that more than 26 million pension savers are unsure what would happen to their pension and who would receive it. A fifth, or 23%, of all those surveyed incorrectly believed that it would go to their next of kin automatically, whilst 11% said they didn't even know what would happen to it. This is incredibly important that you ensure whoever you want your pension to be left to receives it without any hassle. As of October 2024, £31.1 billion is being left unclaimed in pensions. It only takes a second to add people to your pension as a beneficiary, and everything can be completed online, seamlessly and quickly, or over the phone. Most importantly, please check. Make sure you are not leaving your pension to an ex. There have been too many horror stories of people that have set up a beneficiary in the past and now they are divorced from that person and do not want that pension going to that person. So make sure it's as seamless as possible after you pass, that your loved ones can arrange and sort this out as quickly as possible. Tip number 3, state pension top-up. Log on to the government website and check if you have any missing or incomplete years in your past. Make sure there's nothing that is out of ordinary and you are going to get the maximum state pension. You have until the 5th of April 2025 to pay voluntary contributions for anything that's missing or any gaps between April 2006 and April 2016. After the 5th of April 2025, you'll only be able to make voluntary contributions for the past 6 years. So that window of opportunity for that decade previously is going to get shut. As an example, a full national insurance year usually costs around about £824 and adds up to £328 a year into your pre-tax state pension, meaning as long as you live for at least 3 years after you've started claiming your pension, you're going to be break even. Now, there are lots of ways to plug the gaps if there are some missing, not just by making a payment. If it's not being recognised that you are caring for a child or on statutory sick pay or caring for a loved one, all of these things can contribute towards that. I've left a great link down below into a money saving expert article which details all the things that could be contributing towards this. With average life expectancies only going up, this one could earn you thousands into your retirement. The first 3 years is breaking even if you've had to pay to top up, but everything after that is your earnings from your state pension. Please check this, because from April 2025, this is changing and you will only be able to claim the last 6 years and not that previous decade. So double check, triple check, especially if you're coming close to that retirement age. Tip number 4, tax relief on your pension contributions. This one could be worth thousands waiting for you to claim that money back into your personal bank account. There are 3 ways that an employer can pay your pension, and let's take a look at each one now. Firstly, employers can pay via your net pay. This means that your pension contributions are taken from your salary after national insurance, but before income tax is deducted. This means you only pay national insurance on the contributions and no income tax needs to be claimed from HMRC. For example, if your monthly contribution is £100 a month, the full £100 makes it to your pension. In contrast, if you just received this amount with the rest of your salary, you may be having to deduct a further £20 or £40 from that money, depending on the rate of income tax that you pay. The second way that your employers can contribute to your pension is something called relief at source. Your pension contributions are taken from your salary after both national insurance and income tax are deducted. This means you pay both national insurance and income tax on the contribution, and then the tax relief is then claimed by the scheme that is effectively managing your pension. This means they'll claim 20% income tax from the HMRC directly. However, if you have paid tax at a higher rate than 20%, you personally will need to claim that additional tax back yourself. This is repaid outside the pension scheme, which means you get it directly in your bank account. For example, if your salary is £2,000 a month and your pension contributions are 5%, you will pay £100 a month into a pension. To achieve this, your employer will take 80% of your take-home pay and then top up your contribution by £20, which they will later claim from the HMRC. However, if you earn £6,000 a month, you still only get 20% added back on, which means the government owe you 20%. They owe you that contribution back into your pension. You need to claim that manually via a self-assessment tax return, and it can easily be done either online or via the post. Please, please, please check this. I know of thousands and thousands of people, or I've heard of thousands and thousands of people who have made this claim and got thousands of pounds back into their bank account directly. This one is a big one, and you can claim back all the way up to 4 years in the past. The third way that employers can contribute is something called a salary sacrifice. You agree to effectively waive part of your salary in exchange for your employer making the contribution to your pension. This means you don't have to pay any national insurance or income tax on any of the contributions you make to the pension. Some employers will even go a step further in giving you some of that national insurance contribution that they would have had to have paid into your pension. For example, a previous employer of mine would pay 50% of national insurance into my pension that they would have otherwise paid. The simplest way to explain this is if you earn £50,000 a year and you choose to contribute 10% into your pension, your employer will effectively make your salary £45,000, putting the £5,000 into your pension. This is the most tax efficient one and the one that I use, but it does have drawbacks when it comes to leveraging your salary against some sort of financial asset such as a mortgage. The reason for this is your salary is technically lower than it was previously. So rather than having a £50,000 salary, you effectively only have a £45,000 salary. So be mindful of it either way. Depending which method your employer chooses can have huge impacts, and for some, it can have thousands and thousands of pounds of unclaimed money that is waiting to come back into your pocket. In the last 5 years alone, £1.3 billion has been left unclaimed by higher rate taxpayers due to relief at source. That is your money that's sitting in the government's hands and could be better used in your pockets instead. But get moving quickly. You can only claim the last 4 tax years and we're already coming up to the end of this one. If you are unsure what type of pension you have, Monday morning, simply ask your pension or HR contact at work, is our pension salary sacrifice, relief at source, or net pay? Or simply just ask what type of pension we have. If possible, consider opting for salary sacrifice if your employer allows it. But this will need to be checked against what your financial needs are and your goals for the long run. Tip number 5, start planning your retirement. It's possibly the most boring, but equally the most important. Just start planning. Calculate a figure. It doesn't have to be perfect. It doesn't even have to be right. But at least have something to aim for that you can monitor year on year. There are lots of rules of thumbs here and none of them will be perfect. But I like the Trinity study as a starting point. This suggests that you can withdraw 4% of your pension after retirement age safely without any impact. And as such, that means that 25% of your expenses is a good starting point. Firstly, start by calculating your current monthly expenses based on your current expenses and then times that by 12. That will get you your yearly figure. Then times that by 25 to get your retirement number. This is the number that you will use and monitor. This number will almost certainly be wrong, but it will put into perspective if you're heading in the right direction or not. The Retirement Living Standards have a good table for reviewing what a minimum, moderate and comfortable pension might look like in later life. It is, in my opinion, flawed, but it does work as a benchmark to start with, and that is linked down below. Then, every year, evaluate your number. Has your expenditure gone up? Has your lifestyle expectations changed? Are you now used to driving around in Ferraris and Lamborghinis? Is your financial position different to what you planned when you planned this number? The main thing here is to start planning, start thinking about your future, and start having a target to aim at. Everything we spoke about today and more will be referenced in the links down below. If you are unsure, you can get completely free government-backed advice from the Pension Wise if you are over the age of 50. Use it. It is completely free, and making incorrect decisions so close to retirement could cost you thousands. Please do not be one of those. But don't panic. Just be calm and ask questions. My common mantra is that information makes for informed decisions, and you can only start making informed decisions once you start gathering the information. So gather the information and then take action. If you found this video helpful, make sure you hit that like button, subscribe for more money tips, and comment down below. Did any of these surprise you, or any of these you didn't know? Stay smart, stay savvy, and keep that money growing. And until next time, happy saving. See you soon.